whether company will make profit or not. It is not actually decided by profitability ratios. It is actually decided by efficiency ratios. If company is able to use its assets, its capital, its resources efficiently, then only it can make profit, otherwise it cannot. So welcome to this video. In this particular video, we will talk about efficiency ratios, or rather popularly called as turnover ratios. And this are going to be real eye-opening, super amazing video for you. So I see Amit Popat welcome you one more time to this investing mastery series which has been going on since last 18 days. And let's jump into this video and learn something new. So efficiency or turnover ratio. As the name suggests, turnover ratios, it typically means whatever resources company has. In fact, I've written it as well, that whatever resources company has, how much turnover it is able to generate from those resources. I'll give you some examples so that you can understand. Like, I don't know how many of you belong from Udaipur. If you're from Rajasthan, Udaipur, just type in me in the chat box. Like, if you go to Udaipur, there is a palace, city palace, right? Which is owned by Maharaja Laksharaj Singh Mewar as of now. So that palace is an asset. It's a good palace, huge palace, big palace. But what if Maharaja Laksharaj Singh does not use that palace to generate money? Two things will happen. Number one, इतना बड़ा palace है, he will be incurring the maintenance expense on that. So his wealth will go down because of the maintenance and he will not be able to generate any revenue. See, he need a part of that, not the entire palace. And the example is in front of you. What Maharaja has done is that palace has been converted into a tourist spot. In fact, there is a Taj Hotel as well. When you go into that hotel and all that. So, and this is not just city palace. Many palaces. There are Jaipur, Jodhpur. Many royal families have converted their palaces into the hotels, and they are able to generate significant revenue. So, what does that mean? That means they had the asset, but from that asset, they could generate the revenue, they could generate the sales, and that shows their efficiency. Because of that decision to convert their palaces into hotels, of course, all the royal palaces are making good money, and royal families, and that's good. Nothing wrong about that, right? So this is what we got to be talking about. If a company can generate higher turnover from the very same resources compared to its customer, definitely the chances of that company outperforming others is going to be far better. Like, if one company has got a factory, another company has got the same factory, they put the same capital to establish this plant factory. But if one company is able to run that factory in a double shift, triple shift, and they can generate the more turnover from the same factory, same plant, then but naturally wealth of that particular company will grow faster than any other else. It is very simple. Fair enough. Okay, let's move to the next part now. So the first ratio that we want to talk about is a it's a fixed asset turnover ratio. It is not total asset return is wrong. So in the example that we have been carried forward since last four videos are, we could have our sales of 1.5 lakhs and our fixed asset in the balance sheet that you can check if you go back three videos back is 65,000. So that typically signifies that my fixed asset turnover ratio is 2.307 times. Now ideally this is a very low. If by having an asset of 65,000, company is able to generate only 2.307 times of turnover, ideally there company has to put more effort to generate the turnover. But here, as you know, I've given the caption as well, that fixed asset turnover ratio measures companies efficiently to utilize its fixed assets. If it can generate higher turnover using same assets, then but naturally companies profitability will increase, because every time you make sales you make some money, you make some profit. It is very simple. So if you can generate more sales, your profitability will be more. Now here the fixed asset turnover ratio, it's a good ratio, but it can be deceptive sometimes. It can be deceptive sometimes in two ways. How it can be deceptive. Reason number one why fixed asset turnover ratio can be deceptive is if company has rented majority of the assets, like if company is working on a rented properties, then the amount of fixed asset appearing in the balance sheet will be very, very less, as in our case as well. We have rented the shop, the 65,000 appearing in this ratio as well as in the balance sheet is just the furniture. But if I talk about Ahmedabad, if you want to buy a shop, it will cost you minimum 60, 70 lakh depending upon which area you are buying. This is a bulb on moment for you. Type in bulb on in the chat box. Right? Oh my God, this can go wrong. Okay. So sales divided by fixed asset, there is a problem with this ratio, and that is if fixed assets are on a lease on a rent, then this ratio might show good, wrong picture. It might show that company is super efficient, which might not be the case actually. So now going to the next, total asset turnover ratio, sales divided by total assets. So what is the logic over here? The logic over here is that even if the fixed asset can be on lease, but when I take denominator as total asset, the stock, the debtors, the cash, that means I'm including the current assets as well in the ratio. Now stock, debtors and cash cannot be on a rent. I hope you're getting my point, right? So if I've got a rented property, I've got a rented shop, I've got a rented factory, plant machinery is leased, but your inventory cannot be leased. So if the huge amount of inventory is piled up and the sales is not there, that will easily be shown in the sales upon total asset ratio. That's the whole logic behind it. So in our example, sales is 1.5 lakhs. Total asset, as the picture is getting very, very clear, 2.4 lakh. It is only 0.625 time, which is very, very less. Company has to work on this. Okay. So total asset turnover ratio measures company's efficiency to utilize its total assets. If company can generate higher turnover using same assets, then but naturally its profitability is going to increase. Then we calculate the same ratio. Will not get much into this. Capital turnover ratio, sales divided by capital employed. It measures company's efficiency, then how capital has been utilized. Whatever company capital company is, put in the business, it can be in the form of equity or it can be in the form of debt. That is already we have seen in the leverage ratios. Is company able to generate proper turnover from that capital? Is company able to utilize that capital efficiently or not? Okay, that's what we try to calculate in this particular ratio. So fixed asset, total asset, capital, having done that, here we try to look at the operational ratios. Next three ratios, we're going to look at the operational ratios. Like the first is the debtors turnover ratio. Okay, right from the beginning, I'm telling you, from this ratio onward, I'll not be using the numbers that have been placed in the P&L balance sheet that we have been using since last four videos. Here, I'm going to take a bit different number because when I was forming that example of Sanju's Kirana shop and all, I tried to keep debtors and creditors very, very less. There was only one sales. But here to explain you the true essence of this ratio, I'm going to use the different numbers than those mentioned in the example. So be careful about that. So debtors turnover ratio formula is credit sales divided by average debtors. What does it try to calculate? Let me just give you some numbers and you'll get better idea. If for example credit sales is 3 lakhs, average debtors is 30,000, that means 10 times. Now this 10 times is a very, very important, very, very crucial. What does it mean? See, there is a concept called as operating cycle or cash cycle. How it works? So when a new business is started, it starts with cash. It purchases goods or rather raw material. It converts raw material into finished goods. Finished goods are converted into debtors and then debtors pay you cash. So that's how the whole cycle runs. Again, I repeat the cycle. Cash, buying raw material, converting that into finished goods, selling them. So that will mean debtors and debtors will give you cash. So the whole cycle must run fast. If company wants to make best profit, higher profit, super profit, then guys, it is mandatory that the cycle has to run super fast. And this, whether the cycle, whether company will be able to run this cycle in a faster speed or not, that will decided by whether debtors are paying you money or not. To give you example, like companies, machinery, production process, operations are super optimized. It bought raw material in just in time, converted into finished goods, sold as fast as it can because it has a good sales team. Sales team is being incentivized. Awesome. But the daters are not paying you money. Company's money is stuck into daters. So now it will not be able to purchase new raw material because it doesn't have cash. Of course, you may say that Amit, they can buy credit. Yeah, they can buy credit, but what if they are not able to pay? Because earlier raw material that you would have purchased on credit, probably you wouldn't have paid money for that as well. Okay. So this ratio is a very, very important ratio. You must collect money from the daters as fast as you can by giving discount, by giving cash discount, because then only you will be able to run your business. Okay. So here it says 10 times, and if you just reverse it, credit sales divided by daters. If you just reverse it, average daters divided by creditors, you get average collection period. How much time the company is taking to collect money from the daters. If you want in terms of days, you can multiply it with 365. So here I get 36.5 days, and debtors ratio indicates company's efficiency to collect money from the daters. Company got to be very, very efficient. I have seen some companies that are very good at sales, but very poor at collecting money. When I used to do my articleship in CA examination and all that, we used to go to Pune to audit a travel company. Of course, I'm not going to name. The travel company was very good at selling tickets. They had a huge business. But when we went for the audit, company was really going through the liquidity crunch because the daters were not paying money. Company was struggling to pay the salaries. Company was struggling to pay to the airlines for the tickets that they had booked for the clients, and the whole business got stuck because airlines do not give credit beyond a point. Okay, very important ratio. I hope you're understanding that. If you're understanding, type with you in the chat box. Please type with you in the chat box. Creditors turnover ratio. Formula is very simple. Creditors turnover ratio goes like credit purchases divided by average creditors. Let's say, for example, I'm taking credit purchases at 2 lakh. Average creditors standing in the balance sheet is average is 40,000. So that gives me 5 times. What does 5 times mean? That company has been able to procure material from the creditors and paid. That cycle has run 5 times. So, but naturally, if 5 times creditors have been paid, you would have generated some sales and money would have been collected. So that's a good sign. And if you want to get the average payment period, just inverse it. Average creditors divided by credit purchase multiplied by 365. So here we get 73 days. But now here it's a very, very tricky ratio. You've got to understand this. This is a very, very tricky critical ratio. Now, average collection period, data's ratio, I'm talking about the previous one. Lower the better. No doubts, no ambiguity, lower the better. Because lower average collection period means average collection period. I'm not talking about data's turnover, I'm talking about collection period. If company is able to collect money from the data in a lesser number of days, that means company can put their money back into the business and they can generate more sales and more revenue. So with that same logic, you might say, Amit, if for daters, collection period less is better. For creditors, payment period more is better. Because if creditor period is more, that means in this particular example, there is a 73 days. You can tell me, Amit, this is very good. Company has been able to negotiate good with the creditors. They could convince the creditors because of the bulk they are buying or whatever damn reason that okay, we're going to pay you after 73 days, and company can use that money in generating the more money, generating, working, keeping the operating cycle running faster. You might tell me, Ahmed, this is beautiful, 73 days. Company has been able to negotiate good. Yeah, that is one point. I totally agree with that. But the other point is, somebody can think it of like this as well, that company is not able to pay its creditors, and that's why the credit period is higher. Yes, makes sense. So this is why fundamental analysis gets a bit tricky, and that's why everybody is not very pro at that. You need to connect the dots. You got to see, like, okay, if creditors payment period is higher, you got to deep dive into it, that why it is higher. Is it because of uh, company's efficiency to negotiate better with creditors, or is it because of the liquidity crunch that company is not able to pay? And that is one of the limitation of ratio as well, that it only talks about quantitative factors. So if you can just correlate the journey that we are having, we started off with a simple income statement, balance sheet, then we calculated ratios, and now we are saying that even ratios are not good enough. You got to be subjective, you got to be having analyzing mind, right? So the things I discussed, creditors ratio is a bit tricky to interpret, as higher payment rate doesn't always mean companies negotiate power. It can also be due to liquidity crunch. And the last ratio that we are talking in this particular ratio is stock turnover ratio, COGS divided by average inventory. I'm taking the actual numbers, and inventory holding period is just inverse, average stock divided by COGS. Again, it shows how long company is holding their inventories. Ideally, lower is better, because lower inventory holding, I'm talking about the inventory turnover. See, all turnover ratios, it goes without saying higher the better. All turnover ratio higher the better, because higher the turnover, higher is the money, higher is the revenue, higher is the profitability. Inventory holding period, higher is, I would not say higher is better. It's lower is better, because of course it is inverse of that formula as well. So if there is a inventory holding period is lower, that means either company is able to procure its material in a such a beautiful way, like using JIT and all that. And if we talk about finished goods, this typically means company has been able to sell the material, the goods that is produced, it is producing in a better way, in an efficient way. And if company can generate sales, if other ratios go well, like I was talking about data turnover ratio, company is super efficient. It is converting its inventory into data very, very quickly. But at the same time, we also got to ensure that data pay us money. Then only that whole working capital cycle will run perfectly. So this was efficiency ratios, guys. I hope you loved it. You are enjoying the investing mastery series. Do let me know in the comment box that what is your key takeaway learning? What was that aha bulb on moment for you from this particular video? I'm looking forward to your comments. Thank you.